But in commercial, you kind of go, the rent came in, the money went out, some extra money in my account. Have I forgotten something? I don't care about anything else. I'm irrelevant to my risks. I had a very one-dimensional investing strategy, and I see it today in a lot of investors too, because they're coming new into this market. What they didn't understand was Rockhampton has been a 9% town for 20 years.
Today, we're talking about something that most people never touch, commercial property investing. When we talk about commercial property and we think of it's kind of a world that reserved for big investors, but our guest today, Helen Tarrant, has made it her mission to open this world up to everyday Australians. And she's an investor, author, and the founder of Unikorn Commercial Property. And she has helped hundreds of Australians to buy their first commercial asset. So Helen, welcome.
Thank you, Irene. Nice to be here.
So Helen, I want to start from the beginning that you built a name in an area that is not exactly mainstream. No. And how did this all happen?
It was driven by being first-generation migrants and helping my parents to retire, because I was an only child and my parents are totally financially illiterate. So they knew about working hard, just didn't know how to invest at all. But the problem was, when you're an only child, you're stuck with them, and if you're Asian and you're an only child, you're stuck with them till one of you dies. And that's how it works. Like, you're the property of your parents, and your whole responsibility is to take care of them in retirement. You know, when you're in your 20s and you've got aging parents coming along and you're going, well, how do I replace their income? And you realize that residential wasn't going to be able to do that, because buying 3 properties, the typical Australian gets tapped out serviceability wise. They have no servicing. How do they go to the next step? How do you turn $50 into $5,000 in passive income? That was my biggest dilemma. And I realized that, there has to be a different way. When you look at the bigger investors, the people who are truly wealthy in Australia, they invest in something else. They didn't do it out of residential, go and buy something in the middle of regional Australia. And I realized, being in a salon, that I was working as a beauty therapist, and that Bill, who owned the building, used to come in and collect rent. He used to collect rent from the hairdresser, from me, from the massage, and then go fishing. And I thought, well, that's a pretty good life. So
that's
Bill,
a very good life.
Tell me about your life, right? Tell me how you got here. And he said, I own this building. This is my entire retirement. And my daughter was going to be a hairdresser once upon a time. And I bought this building thinking, she might work in here. But now, I've created more tenancies. And I just look at it and I think, wow, I think that's what I wanted to do, was that if one property could retire you, then that's what I wanted. So I started looking for commercial properties. There was literally no information. There's no information on commercial property. And the only information I had was from the US. And the US have a different tax system. So we can't apply any of the strategies here anyway. How do you even find out about commercial property?
Did you find a mentor at that point?
No. So everything I do, everything I've taught, everything I've done, trial and error. So all of my education, everything's been trial and error. I started looking for a commercial property. And I think when you first start in commercial property, you have the same thing that every investor that looks at any kind of investment that's property-based is, I want it to be my backyard. I want to be able to drive to there, touch it, feel it, something goes wrong. Yeah. So I had the same.
Something tangible.
Yeah, something tangible. So I did the same. So I live in Sydney, and this property was in North Sydney, so it was driving distance. And I found a little restaurant. It was about 50 or so square meters. And it was, back in the day in 2012, it was 360,000. So it was like this tiny restaurant. It's the back of an arcade, and it was a Japanese restaurant. And I just didn't really think at the time. I think, today, if my client wanted me to say to me, I want to buy this restaurant, I would have said, no, are you freaking out of your mind?
So you would do it differently.
I would absolutely differently. Okay. I mean, you make the mistakes. I always say to my clients, I'd rather make the mistakes than you do. And from my experience, every time I've gone to a new town, you've been screwed over by someone, by the agent, by some contractor, by even the solicitor telling you the wrong thing because it didn't match up what you needed or whatever. So you always get screwed over whenever you try something new. That's just what happens. It delivered a return. The tenant was always there, even after COVID, even during COVID. 9 years later, I sold it for $1,050,000. On average, it gave me about $400 in passive income from that one property every year, like every week for like the whole 9 years. And I sold it for $1,050,000.
Because the capital growth is like threefold. Yes. And then plus the income, the yield.
And you see, and this happens to our clients as well. This happens to my clients. And it's like the first month you get positive cash flow in your bank account. your brain just cannot compute, because in resi,
Yeah,
you
it's
have to put
always
money
negative.
back in. You at the end of the month,
Yeah.
you calculate how much negative you're going to be and you can top it up. But in commercial, you kind of go, the rent came in, the money went out, and then what else is there? Have I forgotten something? There's some extra money in my account. Don't know what that's for.
When we say commercial property, what do we really mean? Because people think of warehouse to medical clinic to cafe, restaurant. What do we really mean?
So what it is not is co-living and boarding houses. It is a commercial loan that they get, but it's not a commercial property. A commercial property is not a boarding house or co-living. What it is everything else that's apart from that. So it is a childcare, it is a petrol station, it is a pub, it is a hotel, it is your leisure activities. Even if you go to a theme park, that is counted as commercial property, but very specialized. But your shopping centers, your shopping malls, your cafes, your office spaces, your warehouses, your logistics centers, any of those are commercial property. They're just smaller or bigger scale.
Compared to residential property investing, in terms of financing, the investing horizon, what is the major difference?
So major difference is that the commercial property doesn't rely on you for servicing.
What cover the tenants, what cover the costs? Yes.
You're servicing to calculate the servicing of the loan. It uses the lease income and the rental income to calculate the servicing of the loan. Commercial property, they have a magical thing called lease stock loans, amongst other loans that they have, where they use the lease documentation and the proof of rent to service the debt. So whether you own 10 other commercial properties, 10 other residential properties, you're mortgaged to the hilt in debt, you sleep on your mother's couch, it doesn't matter. The mortgage is able to be covered by the rent. It's a tick and it's a go.
So they're actually more evaluating the business itself.
They evaluate the location, the tenant, the versatility of how easy it is to put a new tenant in there. They have their own internal calculations on vacancy level and the ability to re-tenant, the security of the tenancy, the history of the tenancy, and obviously the viability of the tenant.
How much is a real estate capital to get into commercial property?
So depending on where and what kind of profession you are, if you're in the medical profession, they love you, they give you medical packages. Some doctors, that banks give them 100% finance on commercial. So it can be very different. And if you run a business that has a turnover over 500,000, the banks often will give you 100% finance on some commercial properties. However, if you're just a average pay as you go or everyday Australian who's trying to get started, the most popular bracket that most people invest in commercial property at the moment in Australia is 800 to 1.2 million. That's the purchase price of the property. So you need somewhere between a 250,000 to 400K to get into that space.
If you've never given your assets an audit, I would recommend the Family Cash Flow and Wealth Tracker that I personally use. And these trackers have helped me build substantial investable assets before 40. By using the trackers, that you will see your progress in a meaningful visual way and giving you a breakdown of all the assets and liabilities your family has. I have made a video explaining it and how I use the two Google Sheets myself, and start to take control of your finances now. I'll leave the link below.
In terms of returns, I got the data here that Australian share market has about 10 to 12 annual return with 4 to 5% on the income part. And Australian Resi offers about 9 to 11 total return with 3.5 to 4.5% on the yield. And how do returns compare to shares and Resi in terms of commercial property?
It actually is very comparable. So it's somewhere, so I would say it's a broader range in commercial. So I would say it would go from anywhere from 10 to 15%. And the reason is that you have a lot more control over your portfolio. So you're not actually controlled by the market, you control yourself. So let's have an example. I'll give you two examples. Let's say a particular client with a profile that says, I've got some Resi already. So they're starting out in their 40s, they've got some Resi, and let's call him Ben. So Ben has some Resi and he wants to get into commercial. Now, cash flow is really important for him because he's got Resi. So, but growth isn't so important. But he likes to have the same returns of, 10 to 12%. So what he'll do is, for him, he'd probably be a great candidate to go into a regional area. Let's say he's buying $1 million property. He will go into a large regional town, and that's a large regional town with over 50,000 people, preferably even closer to 100,000 people. So he'll go to a large regional town and buy a property that has a cash flow of 7%. That property in that area, because of the large regional, will get a 5% growth. So he'll have a 12% return on investment for his property. And he'll have enough cash flow after he's financed the property, 100% financed, drawing down equity from his residential, then getting a commercial loan. He'll be able to pay all of that, plus any of the costs that he had to finance for, so 110%, and he'll end up with somewhere between $3,000 to $5,000 in hand in positive.
If I compare it to share market, it's more like dividend stocks. But then also you've got a steady capital growth in the background.
Yes. So let's say there's Mark, right? Let's give you the second example. There's Mark. He's also buying $1 million property, but he has no other investments. He's got a house he lives in, but he has no other investment. He's looking to buy $1 million property. For him, he's a little bit younger than Ben. His growth is more important to him because he probably wants to refinance and do it again and buy again. He's got a cash deposit that he wants to get started. For him, the best option is for him to go to Metro. He could go to Melbourne, he could go to ACT, Brisbane, Adelaide, any of the metro cities, preferably not in Perth unless he's getting a really high yield because most people benchmark it wrong in Perth. So the East Coast, let's say he goes to the East Coast, so he's better off sticking to a metro area. Buying a property somewhere between 5.5% to 6% yield. Okay. On 5.5% to 6% yield with a cash deposit, he'll probably clear somewhere around $7,000 to $10,000 in terms of cash flow in hand from that. But see, that was 6%, let's say the net yield from that, or 5.7, whatever it happens to be. But he'll get somewhere between 7 to 9% growth on that property. So overall, he's still at that 13%, 12 to 13% return on investment. He just has more growth in his portfolio because of what he needs versus cash flow from what Ben needs.
If you buy like a dividend stocks, that there is a possibility that the capital growth could be negative. But how about in commercial property? Is that really rare?
So negative growth in commercial property, like all properties, do happen, but it only happens when there is a black swan event like GFC, like COVID, like times when the property is destroyed by major events because it's impacted on the leasability of the property. Residential dependent on market, right? So if the market goes down, it goes down. But commercial, if the market goes down, doesn't matter. Your property may not go down. Your property may continue to go up. So a classic example of this was when interest rate was at its record high, maybe about, let's say, 12 months ago. It was record high in the 7s. Commercial property, everybody thought would tank. The value went up and did not go down. And particularly it went up on medical properties. You have a vet, you have a dentist, you have a medical center. Property value continued to grow. It was growing like 10 to 15%. It's a demand and supply that drives it rather than the market, like in the general market that's influenced in the residential space by interest rates.
I listen to some podcasts and they talk about residential property investing and then they talk about cycles. Is there any cycles in commercial property investing?
It's a very interesting question because for me, and look, it's up for a debate, is that there isn't a property cycle in commercial, but there is tenant tiers. Okay. So the way I see that is every season, the market defines what they consider as the perfect property that is de-risked, everybody loves, as in the demand voted. So it is got the right tenant in the right location with the right type of property. 10 years ago, Melbourne could not keep up with demand with the amount of office space they have to build. At that time, the market defined Melbourne office spaces in prime locations in CBD or CBD fringe was the most sought after. During COVID, when people stayed at home, no one went to the office, the market collectively decided that we all want to buy industrial. It doesn't matter about the tenant. We just wanted industrial property in Metro and willing to pay for it. And this was crazy in Melbourne. Like 2 years ago, they would buy something in the 800s for a warehouse. It's worth 1.8. It went to 1.8 million within 2 years because the market said, this is what we loved. And then after COVID finished, the market said collectively, we really want medical stock. Like medical stock, freestanding medical properties is the chosen choice. Seen in the last 6 to 9 months, childcare booming. Right? So every season there is a favorite.
Let's talk about some realities because stuff can really go wrong. And what are the biggest risks beginners that should know?
So when I first went out and built my portfolio, when I first bought my first property, I was like, oh my God, I fluked it, right? You have this idea, oh my God, I fluked it. Maybe this isn't real. I had a very one-dimensional investing strategy. And I see it today in a lot of investors too, because they're coming new into this market. So the one dimension is I'm chasing yield. I'm chasing returns. I want my 8%. I want my 9%. I don't care about anything else. I'm irrelevant to my risks, but I'm going to chase that, right? I went into Rockhampton, bought 3 properties in Rocky. I've also, went to regional Victoria and also other parts in regional Queensland as well. But predominantly my first purchases, that was because it was 9%. And I was like, oh my God, when you sit in Melbourne and Sydney, 9% returns net, we're talking about net returns, it's huge. If you're paying interest, right, let's say you're 100% financed, you're paying 6% interest, which was at the time, that's $60,000. You're making $30,000 for doing absolutely nothing. Like, that's a lot of money. I didn't consider comparing. I didn't consider comparison. I never compared, at the time when I first got into my first deal, a Rockhampton against a Mackay, against a Townsville. I just didn't understand risk and demographic. Today, I still have clients turn up and goes, I want to find 9%. Sure. But today, you're not going to find 9% in Rocky now. The market's changed. You're going to have to go to a mining town to find it. And they're like, oh, I'm okay with that because I'm getting my 9%. But it is one-dimensional. I would have doubled and tripled my money at a time where it was yields everywhere in the regional area had I had not a one-dimensional investing. And so this is a mistake that first-time investors do in commercial because they believe it's all yield and cash flow driven investment. It isn't. It is actually a risk versus reward.
Trade-off.
You've got a trade-off, cash flow versus growth, right? It is always that trade-off, and they don't think three-dimensionally. Yeah. Now when I invest on a portfolio basis because the wealthy grow portfolios where the everyday investor buy property, right? They just buy something. They don't have a strategy. They don't go, I want to replace $100,000 or $500,000. So some unscrupulous other bias agents have put people into places like Rockhampton during the boom. And we had a boom, right after COVID when the interest rate was really low, into their 6% returns or 7% returns into Rocky. What they didn't understand was Rockhampton has been a 9% town for 20 years. And because of the boom, it's dropped. Once it goes back,
it's not like it tanked, it just went back to normal.
Yeah. And they don't also realise, sitting in Sydney and Melbourne, or even in Brisbane, you don't realise how the nuances when you are in a regional town, the nuances of being a couple of streets away, one suburb away, can impact on your investing. I walk the streets of every suburb that I put our clients into. I do road trips. I understand locally how they transact and how they think. It makes a huge difference.
What role does financing play? Is it harder for beginners to get a loan for a commercial property versus resi?
It's actually easier.
Easier? Because I would think it's harder.
Yeah, everybody thinks it's harder, but it isn't. See, it's a very simple formula. Let's say you're borrowing $1 million. You're buying the same $1 million property. Yeah. The LVR on a commercial property is, you can go up to 80% based, but most people are at 70 or 75%. So 70% is your lease stock loan where they use the lease. So you're borrowing $700,000. So $700,000 is the commercial loan. Let's say that's 6% interest.
Is it normally higher or lower than the resi interest rate?
Believe it or not, sometimes it actually comes in lower than the interest.
Oh, really?
Standard lease stock 5.5, 5.7 at the moment, but let's call it 6. That's $42,000 a year in servicing the $700,000 loan. 6% is $60,000 after all outgoings, that's land tax taken out, management fees, insurance, $60,000. Now you're paying the bank $42,000, you end up with $18,000. The bank is going to look at that and go, okay, $60,000, does it cover my repayments by 1.25%, by 1.5%?
So there's a little buffer.
Yeah, so the bank works it out, and different banks are different. Some banks are going 1.25, some banks says 1.5, some banks who don't want to do your deal will say 1.75. So it depends, right? So there's a whole range. And if the bank that says 1.25, well, your 60,000's already covered that. And that's it. That's just how easy it is, provided you obviously have the 300K, which obviously would be a drawdown on your equity, or you have cash.
Now, let's talk about, zoom out a little bit, talk about the portfolio fit. Say someone already has a shared portfolio and has maybe 1 or 2 resi investment property. Where does commercial fit into the picture? That from your experience that you deal with many clients?
Different strategy suits different people, and I'm always about individualizing the strategy. So ultimately, your strategy or your portfolio needs to have 3 elements. And I've spent a lot of my life building portfolios. It's actually something I really love doing. People come in and they say, "Here's all my bits." Let's just do a dump. Here's my dumps. Right, this is where I want to get to. Just show me how to do that. So my brain goes, "Poof, rearrange this. This is the pathway, and build out that blueprint." So with someone who has some shares, typically that's either in a super or outside, and they needed to hold it for liquidity and also for cash flows.
Yeah.
They're resi because they probably bought it when they were younger. They grew with them over time, and they have at their home, right? So that's a very
Pretty much, yeah.
where commercial comes in. Most of that profile of investors will be doing that somewhere around that mid 40s to late 40s, where they are at the top of their earning capacity. And they're also at the top of their spending capacity. So they're kind of constrained. And they have no more money in the pot because you've got school fees, you've got holidays, you've got mortgages, you've got everything. So you have no more. But the fact that you sit by the sidelines for 5 or 7 years while that clears out of your life, which is, school fees, travels and all this stuff, is unbearable because you've missed the cycle. That's a catastrophic loss to you in wealth creation in the future.
Opportunity cost.
That opportunity cost is catastrophic. It's not like choosing between residential or commercial.
Yeah.
It's like commercial is the only choice now because it doesn't rely on you to service it because you have no more servicing. You've got no money left. What you have is the only bit of equity that you have from the fact you accumulated.
To get you started.
To get the equity that you had in the residential property and the home that you had, they can't go in and buy any more resi because their serviceability tapped out.
Yeah.
So now commercial banks loves you. So you have you have equity, and now you have somewhere between $500,000 to $800,000 of equity sitting. So you go, okay, I did $400K. Now $400K is a good benchmark. You go and access, and typically the first step is not the principal home, but your investment property. So you'll refinance that, and you'll pull out somewhere between $300 to $400K. You'll take that $400K, you'll go and buy a commercial property. And the commercial property will be able to, and in this situation here, you will most likely buy a fringe or a regional property to start with because you need the cash flow. And you let that property sit, right, and brew, right? So that property will finance everything and start giving you a few $1,000s. It's not going to be huge, but in 12 months, as the rates come down and as you have some rental increases, that 3,000 to 4,000 will become 7,000. The next step is, instead of waiting 5 years, because for my brain, like I can't, for me, everything's on steroids. You can't do 5 years. 5 years is too long. So 2 years time, you take that commercial property and potentially your home or your residential, and you try to refinance again, and you buy another commercial, and you start building. Right, you build through the years where you have constraints on your servicing and your cash flow using commercial property. And it's a really great vehicle because you grow your wealth. And I have to say one other thing is that it is fundamental, and this is not personal advice, it is general advice, that you make a plan to create $100,000 of passive income through your super. Anybody in Australia, if you've got a 10-year horizon or a 12-year horizon, you can absolutely do it. Plan it and you execute well, which here at Unikorn we can help you do that. But that aside is that I think everybody in Australia who are in professional jobs, who contribute to their super, can absolutely do it.
So have you seen many investors that they actually buy commercial properties and put it into their self-managed super fund?
1 in 3 of our clients.
Oh, okay.
Yeah.
So very common.
Very, very common. And it's building that passive income in the background that you can't access for 10 or 12 or 15 years that you won't even think about, that is going to pay you dividends when you retire. Cash flow, like tax-free. So if you end up with $100,000 in tax-free income, that's equivalent to $150,000, higher than the average wage here in Australia, but it's indexed over time.
I think property in general, whether it's resi or commercial, is a fantastic diversifier to your entire portfolio. Once you actually introduce a commercial property, it's gonna, because of its value, it's very bulky in a sense that it almost instantly make your portfolio tilted towards one asset class, which is real estate. In your point of view, based on your experiences, do you think an investor that when is the right time to introduce? Do you have to build a foundation so it doesn't, one commercial property wouldn't throw you off in terms of diversification?
Yeah, so diversification is about introducing it at different times and building enough security so that if one part of your portfolio goes down, the other part supports it. So most of our clients will come into commercial, but that's changing now. But most of our clients are coming into commercial in that mid to late 40s. That's always been the tradition. After COVID and this new generation of investors, we're seeing 20s and 30-year-olds coming into commercial property for the first time. They've actually chosen not to get into residential, go the commercial road because they don't want their lifestyle to be impacted. It's really interesting, right?
You don't want to be the slave.
Well, we never thought about that when we started working. Like, we never had that thought, right?
Yeah.
But today, the active 20, 30-year-old is making an active choice to have their lifestyle and eat it, to like travel the world and do whatever they do to be the digital nomad and invest in in a cash flow producing asset rather than residential. It is quite interesting because I'm getting younger and younger people coming and goes, we decided we're not going to.
That's very interesting fact, actually. Because I think that those young people, they must be like well educated. They watch a lot of YouTube.
They're looking for cash flow straight up. Like they're just chasing cash flow because what do you want? I want to retire in 10 years. It's like sometimes I talk to the 50-year-old who don't want to retire in 10 years. Like they're already at 30 going, I want to retire in 10 years. I'm thinking in my head, what are you going to do? I'm going to retire in 10 years. Yeah. Okay. I want cash flow. Everything's about cash flow. Yeah. So I think the thing when you talk about diversification coming back is that I think shares play a really important role in that liquidity, in getting people to diversify into different options and for them to have blue chip, have things that they can also willable to their children and just so much in that space they can trade and do. And someone can start with no money. Right, and a little bit of money and do it. Whereas I think in commercial, you need something. You need to have some deposit. If you've got that deposit and you're making a different choice between resi and commercial, understand. You kind of can't go from having no deposit and going into commercial, no background. I mean, if you got your commercial property foundation down packed, you could go out and do joint ventures with money partners every day of the week. And that's what young people are doing. So when commercial comes in, it comes in almost as the third strategy. So you've got some resi, you've got some shares. But the other thing that may also help to dilute that portfolio is over time, obviously, the share portfolio will grow. But also to consider, and this is just a consideration, is there's certain funds out there or syndications out there that are in the commercial space. If someone doesn't want to skew their portfolio by doing their own, they can go into a syndication.
What are the mistakes that you see beginners in particular make time and time again? You mentioned that chasing the yield.
Yeah. They get to a point where they think they know enough to be dangerous to themselves.
Oh, the Dunning-Kruger effect.
Part of my job is telling people not to buy something, and they get very offended. It's not because I run a buyer's agent. It doesn't really matter. Like, I'm just going to tell you straight up, that's not going to work, right? There's certain things that experts will be able to see. It will take me 10, 15 minutes to assess a deal. Like, someone will send me everything. I'll just go bang, 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 bang. Your brain just goes, this is the problem. And they go, how do you know?
How do you know? Based on years of experience.
I look at this stuff every single day. The typical mistake is that they miss their due diligence pieces, like the key due diligence pieces, and they fancifully think what's a deal breaker is not a deal breaker. People forget to take out everything in their outgoings, because in resi, the way you take out outgoings is very different from commercial. I've taken out all the stuff I think it is, and then you come in and go, what about those three things? Let me run that deal for you. That's not a deal. It doesn't work. So that's the number one thing, is they get their numbers wrong. The number two mistake is your potential or big capital works, right? Because those things are going to hurt you. And commercial property is not very forgiving around that. It's like in resi, I go, okay, maybe I can budget up. It costs a few hundred, it costs a few thousand. Everything adds an extra zero on commercial. People make that mistake because they miss it. Like, didn't check the aircon, didn't get the reports, looked new. The pest and building didn't pick it up. Well, yeah, you pest and building don't check aircons. I got my solicitor to do my DD. Your solicitors read leases. They don't do DD.
Wrong person.
A lot of people get their solicitor to do due diligence. Your solicitor doesn't do due diligence. My accountant did my DD. Your accountant reads numbers. He can tell you that these numbers work, but he can't tell you that the roof needs replaced in the next 5 years and it's going to cost you 200 grand. Right? They don't tell you these things. The pest and building didn't pick up on our electrical issues and asbestos issues. Yeah, because they're things that systematic needs to be ticked off in DD for your type of property. If you're doing due diligence on a warehouse, it's very different from doing a due diligence on a retail shop. They're just two different things. So people take one lot and go, this is my general DD, and they miss stuff. They just miss stuff out of there. But these don't add more value. They don't increase your rent. They're fundamentals. Your tenant's not going to live there if that's not happening. We have a rule that if we're doing, if the property is over 2 mil, we'll cite it. Like myself and my business partner, who's in the building business, will cite that deal. Google Maps is great to walk around the streets, but that's not going to tell you what is happening between the neighbors next door that's going to impact your tenancy. What's going to happen, like that there's 5 other competitions for your cafe that's going to impact on your cafe. Those things that if you're not on site, you actually don't know. And so I'm a big advocate as commercial. You go on site, you feel, you see, and you walk around the area.
As a beginner, even that you walk on site, you probably don't know what you don't know.
Well, that's right.
You don't know what to look out for.
Yeah. So as a beginner, like, there's no point to say, go and inspect your own property. Like, you don't know what you're looking for, right? So exactly. I had this really funny moment. And I only tell you this story is because we had some staff member coming from overseas. And I sent our DD guy and one of her guys who does the preliminary acquisition. So he goes and just scouts out the properties. I like a bit of a property scout to do a property inspection of a resi property, right, for lease, because I didn't have time. And they both came back with different videos. So it was so funny because the guy who's doing property acquisition goes in and he goes, here, I'm just going upstairs. This is what I'm looking at. Look at this beautiful thing, blah, 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 blah. And he does this stuff.
The glory.
The glory of it. So he gives me this. I'm like, okay. So then look at the DD guy's video. I see nothing about the property. Right? I have no see the front door. I don't know the location. He just goes, oh, so there's a scratch here. Yeah. And I'm looking at the ceiling and there's holes on this ceiling. And if you look at this floor here, and it was all defects, what needs to be replaced, I
totally from different angles.
And I was like, I don't even know what this property looks like. I don't know nothing about what the room looks like. You just showed me all of the stuff that could. So that's what I mean about DD. Like, when you walk in, you look up, you look down, you feel, you knock on the walls.
So Helen, this has been an eye-opening class for us. Commercial property sounds very intimidating for most of us, and you made it much easier. So if any investors, they want to learn more about commercial property, where do they go?
So I've got a channel. So go to Commercial Property Roadshow with Helen Tarrant. So just Google Helen Tarrant on YouTube, you'll find it. There's you can follow me on Insta. The main thing is commercial property just speaks a different language, and that's the fundamentals I'll leave you with, is that it speaks a different language, and you're not going to get a deal done if you're going to try to speak English in a Mandarin environment. I always say, look, doing resi is English and doing commercial property is speaking Mandarin. If you take everything, you speak English in a Mandarin environment, try to get a deal done, you'll be wrong. It's not harder than resi. It just speaks a different language and it has a different system of working. And so you just got to go with the system. You can't, especially if you're new, understand that process, because that's where also they fail, is that they contend with a product, go and put an offer in, they don't know what the process is, and they've put in to subject to XYZ, or they decided, okay, it's an unconditional contract, because in resi a lot of it is, and they don't put any of the terms in. And so, but then they don't exchange contract for 2 weeks and they end up losing the deal. In commercial, like, there's often terms, but they want you to exchange within 24, 48 hours, right? Because they agree to your terms. That can be very different. That can take, you can lose the deal. So understand that process if you're a beginner. Just helps you to get into the market.
That's really helpful. Thank you, Helen.